Now that 800 billion of the monetary base, let me remind you what that is. The Federal Reserve balance sheet, assets and liabilities, and basically a year ago when we had a credit crunch and there was no ability by institutions to sell assets, to get cash, to pay off margin calls. What the Fed did was they stepped in and they made loans. And up to that point, they had treasuries on their balance sheet to $800 billion, all paid for by Federal Reserve notes. A year ago, what they did is they made loans to the private sector. They made loans to banks. They made loans who were facing, deposit withdrawals, and they needed cash immediately because basically they had a capital call. And it's instantaneous. The maturity of a deposit is the end of that banking day. So you need cash immediately. So these are loans to banks, loans to non-bank financial institutions, NBFI, and that would be the investment banks who are having a similar situation where they were having margin calls, and they're, given quote counterparty risk, people were pulling money out of the investment banks. And if they had to sell assets, the asset prices would have gone down further and faster. So the Fed was making loans to them so they didn't have to sell assets. And then they made loans to corporate America, and that was called the commercial paper market. Now the Fed is heavily buying residential mortgage-backed securities, so they're financing us. On top of that, they're financing us because they're buying credit card paper. So we're getting financed ultimately by the Fed. So the Fed stepped in and made all these loans or bought securities. These are residential mortgage-backed securities or credit card securities. They also added some more treasuries. Now, how they pay for this stuff is basically they write a check. The check goes to the commercial bank, and the commercial bank decides of the proceeds of the check, just like you and I receive a check, we go to our bank, and we decide how much to put in our deposit account and how much to take in cash. So basically, the commercial banks who were getting the checks deposited with them made the decision how much they wanted to hold in dollars and how much they wanted to hold in member bank reserve deposits. Either way, and by the way, this is called the monetary base. And it's going to be the same on the Fed's balance sheet as the commercial bank's balance sheet, the MBRDs. The distribution of the liquidity is really made by the commercial banks. How much to deposit, how much to take in cash. Taking cash means fill up an armored car, deliver the money. So basically, as the Fed, quote, printed money, and I didn't want to use that phrase, but that's, wrote checks. And then the bank decides how much they want in cash and how much they want to put in deposit. That became liquidity. For those of you who are veterans of McCombs, you might recall how it was taught in money and banking and macroeconomics. This then allows the commercial bank system to ramp up this liquidity at some multiple, and it would usually be a multiple of approximately 10, where they can make loans to you and I and pay for them with deposits. And the ratio is about 10 to 1. So this added $1 trillion that the Fed put into the monetary base a year ago could have conceivably resulted in about $10 trillion of loans to you and I. But I've already showed you the commercial bank balance sheet. They're lending less to the C&I loans, and they're lending less to the consumer. So all that monetary liquidity was created at that monetary base leap, but no lending took place. Now, the reason I say the Fed is at a dead end is last summer when we did the June discussion, the fear in the market at the time was palpable that indeed what we learned in money and banking, or what we taught you in money and banking, would happen. That this big surge of liquidity would result in a doubling of the balance sheet of the commercial banks, which means they put a lot of money in our pocket to go out and buy stuff, and we'd end up creating inflation. Well, we got a couple months into this recession, we found out we're having deflation instead of inflation. And the Fed try to get rid of the fear of inflation, because it caused the long-term Treasury rate to rise about 100 basis points above today. And then in a masterful PR stunt, and I got to call it a stunt, I couldn't believe Bernanke goes on national TV on 60 Minutes, and he talks about our exit strategy. The whole reason for his exit strategy discussion to Mr. and Mrs. America via 60 Minutes was to create the impression that the Fed would undo all this, and they can undo all this, and basically sell those loans or not refinance them and get the liquidity back. But he was doing it to say we have to have an exit strategy, and he was trying to throw a lot of cold water on the inflation expectations that he created. That was in June. Now we're what, 6 months, 5 months later? No, 4 months later. The big problem with the Fed now is not that they're taking the money and running and lending it. They're taking the money and they're not lending it. So they're not going to exit. But the Fed basically got to a point where the market reined them in. And the reining in of the Fed that you can't expand the balance sheet is you create inflation panics. And inflation panic causes the interest rates to rise, and that's the last thing you want to happen during a recession. So they found out the outer limit of how much the market would tolerate them, and they're now trying to figure out some way to, quote, seemingly exit without really exiting. It's a PR problem. In a lot of ways, I could give about an hour on ways they could create the impression they're exiting without exiting. But nonetheless, the problem is the Fed maxed out. They can't expand any further. To make the point even clearer, in about April of this year, the Fed said they were going to buy, what was the number? It was, I think, $1 trillion of treasuries, or some very large number, which is, we're putting out $1.4 trillion. The Fed said they'd buy $1 trillion of it. The Fed, after the inflation panic they created, ended up saying, okay, we're putting the government on a budget, a limited budget. We're only going to buy $300 billion this year. Right now we're up to 289. So they're just about, the government's at its line of credit with the Fed. So the Fed has been reined in, and the market reined them in because of the inflation expectations they created. So we're not going to get much help from the Fed. We already have enough liquidity in the pipeline. Remember, this level of liquidity or monetary base was accumulated from 1914 to 2008. So that's the accumulated balance sheet of the Fed for its first 96 years of history, and then we doubled it. So they could actually contract this, and we still have a lot of excess liquidity. But what's happening is the market's not taking the liquidity. The banks are not taking liquidity and lending it and doing any good for the economy because they don't have the capital. They're not making the capital requirement. So the excess liquidity is doing nothing except creating a problem of inflation expectations. So the Fed has really been, held in check by the market.